So let's talk about real estate in 2026. Is it the golden ticket to building wealth, or is it a financial time bomb just waiting to go off? That's the huge question we are tackling today. You see all the headlines, all the uncertainty, so we're going to break down whether you should be buying, selling, or just sitting on the sidelines.
Okay, let's just get right into it. The headlines are, frankly, all over the place. You've got some analysts screaming that we are on the verge of a historic buying opportunity, while others are predicting a complete and total market collapse. So, where is the truth in all that noise? Well, to find it, we have to look past the hype and really understand that there are two fundamentally different ways to make money in real estate. So, here's how we're going to break it all down in this explainer. We're going to look at those two opposing strategies, the quick profit flipper versus the long-term investor. Then we're going to dive right into this potential market storm brewing for 2026 that could honestly change everything. And finally, we'll help you figure out which path, if any, is the right one for you. All right, let's start with the strategy you've probably seen on TV a million times. This is the world of the flipper. It's a high-stakes game where all the profit is about timing and, well, a little bit of transformation. You see, it really boils down to two main approaches. You can be a speculator, someone who's focused on making a quick buck by buying and selling. Think of those big TV personalities like Armando Montalongo. Or you can be an investor, focused on long-term wealth by buying and holding, the classic strategy of someone like Robert Kiyosaki. One is basically a bet, and the other is a business. Let's really break down what that means. Okay, so this slide gets right to the heart of the matter. On the left, you've got capital gains. This is the flipper's entire game. It's purely about price. You buy a house for, say, $200,000, and you're betting that someone else will pay you $300,000 for it pretty soon. It's a one-and-done payday. But on the right, you have cash flow. This is the investor's game. This is all about creating a steady, predictable stream of income from rent, month in and month out. See the difference? One is a bet that the market must go up. The other is a long-term business designed to work in pretty much any market. The flipper's playbook is pretty straightforward, right? First, you have to buy low. Then you renovate to force appreciation. Now, that's a key phrase. It means you physically increase the property's value with upgrades like a brand new kitchen or a finished basement. You're not just hoping the market rises, you're literally forcing the value up yourself. And then finally, step 3, you sell high for a quick profit. It's a very high-risk, high-reward game that is totally dependent on timing the market just right. Okay, now let's completely switch gears and look at the investor's mindset. This is a totally different world. Instead of cheesing those quick profits, they're focused on patiently building a sustainable income machine through something called cash flow. And this is just the perfect analogy for the investor's philosophy. I mean, think about Monopoly. You don't win the game by just buying Boardwalk and then immediately trying to sell it to someone else, right? No. You win by building those little greenhouses and then those big red hotels on it so you can collect massive rent every single time somebody lands there. That rent, that is your cash flow. And it's the foundation of a real investor strategy. So the really crucial point here is how they buy these assets. Investors often use what Robert Kiyosaki famously calls good debt to build their wealth. So instead of using all of your own money, you get a loan from a bank. You're using other people's money, or OPM, to buy a rental property. Then the rent you collect from your tenants pays the mortgage, it pays the taxes, the insurance, the repairs, and whatever is left over. That is pure cash flow in your pocket. You're essentially having your tenants buy you an asset and build your wealth for you. It's a powerful concept. And this strategy gives you multiple, simultaneous benefits, all from a single property. First, you have control. You can raise rents, you can cut costs to improve performance, you get that monthly cash flow we keep talking about. You get long-term appreciation as the property's value hopefully grows over the decades. You get incredible tax advantages. For instance, the government lets you deduct for the wear and tear on your property. That's called depreciation. This creates what's known as phantom income, which is real cash in your pocket that shows up as a loss on paper, so you don't even pay tax on it. And finally, your tenants are paying down your debt, building your equity for you. It's like a 5-pronged attack on building wealth. But here is where things get really, really interesting. There's a massive economic storm potentially brewing for 2026, and it could be a total game changer for both flippers and investors. It could either create the buying opportunity of a generation, or it could cause a complete wipeout. And at the center of it all is one staggering number. $1.8 trillion. That is the amount of commercial real estate debt that's set to mature, or basically come due for payment, between now and 2026. This is being called the wall of maturity. And yeah, it represents a potential ticking time bomb right inside the market.
So, why is this such a huge deal? Well, because a ton of these loans were taken out between 2019 and 2021, back when interest rates were at historic lows. Now, these property owners have to refinance that debt at today's much, much higher rates. And the reality is, many of them just won't be able to afford the new payments. That could trigger a massive wave of forced sales and a potential market downturn.
So, this whole situation creates two completely opposite forecasts for 2026. You have the bulls, and they argue that these high rates have already slammed the brakes on new construction, which is going to lead to a severe housing shortage. And that means rents will absolutely skyrocket, a huge win for cash flow investors who can hang on. But then you have the bears. They're looking at that $1.8 trillion wall of debt, and they see a crisis. They're predicting a tidal wave of forced sales will flood the market, causing property values to just plummet and crush anyone with too much debt. So, who's right? And this brings us right back to our central question. Is real estate a good investment in 2026? Well, the answer, as you've probably guessed, isn't a simple yes or no. It depends entirely on your strategy, your education, and honestly, your stomach for risk. On one hand, you've got the philosophy that debt is an incredibly powerful tool. That in a world of high inflation, just holding cash is a losing game. So using leverage, that good debt we talked about, is the fastest way to accelerate your wealth by buying assets that pay you. But then you have this powerful counterargument that excessive debt is the single greatest risk an investor can possibly take. That high leverage makes you fragile, and when the market turns, and it very well might in 2026, that debt can wipe you out completely. This is the fundamental dilemma that every single investor has to wrestle with. Maybe we've been asking the wrong question this whole time. Maybe the question isn't, is real estate risky, but rather, is the investor knowledgeable? The sources really suggest that even the best deal in the world can be ruined by a bad investor, while a great investor can find a way to make money even in the absolute worst market. The asset itself isn't good or bad. The risk really, truly comes from the person who's pulling the levers. So, is real estate a good investment in 2026? The final answer isn't in the market headlines. It's in your knowledge. Whether you're a flipper betting on price or an investor building a business for the long haul, the greatest risk of all is simply not knowing what you're doing. The more you learn, the better you'll be able to navigate the very real challenges and opportunities that are coming. Thanks for joining me.